Welcome to Ghana Ground Up, Ghana's prime real estate podcast. Today, we're diving into a critical topic for anyone who's got eyes on the property market. We'll be looking at property investment mistakes to avoid. Now, let's be minded that real estate can be lucrative, but then it's not without its risks. Many investors, both new and experienced, make avoidable mistakes that can turn a profitable investment into a financial drain. So then today we're going to look at some common pitfalls, the role of due diligence, and essential risk management strategies. Even though the information in this podcast is targeted towards property investors, I believe that we can all pick a thing or two to guide us today and the times ahead. And on the side, don't forget to subscribe to the channel and turn on your notifications to receive alerts anytime a new episode drops. Let's start with some common pitfalls that property investors often face. Knowing this will help you to spot potential issues before they become costly mistakes. So then, let's dive in. Now, usually one of the first pitfalls people encounter when they're investing in real estate is that they end up underestimating the total costs involved. And for more on this subject, do well to check out episode 10, which discusses this into detail. Back to what I was saying, often we see investors focus only on the purchase price of the property and then they overlook many ongoing expenses, which include maintenance costs, property taxes, insurance, utilities, landscaping, and sometimes even renovation costs. But then, if you have a company or a property agent managing your property, you also need to factor in their fees and commissions. If you don't budget for all these expenses, then they can eat up into your profits, leaving you with less than what you expected. Sometimes property owners end up adding some margins to the prices to cover these expenses. But then you've got to be smart about this so you don't end up overpricing your property and risking it being on the market or being empty for too long. And sometimes property owners end up adding about 10 to 15% margin on the prices to cater for some of these unforeseen expenses. The next pitfall to avoid is emotional buy-in. Now, many people fall in love with a property simply because it's in a beautiful area or it's located in a popular place. And as an investor, your goal is not to necessarily buy something you love personally, but rather you want to buy something that fits your investment strategy. You have to ask yourself if the property aligns with your investment goals and if it brings the rental yield or appreciation you're looking for. If you allow your emotions to drive your purchase, it can lead to either you overpaying for the property or buying something that may not perform well financially. So then, don't get so emotional about the property you're investing in. It's safe to keep it strictly business, no strings attached. Moving on, another pitfall is over leveraging or borrowing too heavily. Now, let's take a side step and look at the concept of leverage. Financial leverage is basically a strategy of borrowing money to invest in assets. And the goal is to have the return on those assets exceed the cost of borrowing the funds. So then the goal of financial leverage is to increase your ability to make profit without using additional funds or additional personal funds. Simply put, you're using other people's money. Consider you're buying a rental property. If you can make a down payment of, say, 20% of the property price, you can borrow the remaining 80% from a lender to acquire the property. So you're either taking a mortgage or taking a home loan. And if this process goes through, you can then rent out the property and then use the rental income to pay the principal and the debt which is due every month. If you can cover your repayment obligation using the rental income, then you have successfully utilized leverage to own a property. So in a sense, financial leverage is not complex, but then you need to get it right. When you rely too much on debt without factoring in your cash flow, you put yourself at risk. Now, if the market dips or if the rental income you receive is less than what you expected, you may find out that it's difficult to meet your monthly repayments. And that's why it's important to balance the funds you borrowed with your own equity to ensure that the rental income from the property can comfortably cover your debt payments. In simple terms, Don't rely heavily or entirely on loans to buy a property. Instead, try and invest some of your own money, that is equity, if you have it, alongside the borrowed money, which is the debt. This reduces your risk because you have less to pay back and more financial flexibility. This matters because, number one, if you borrow too much money and something goes wrong, like let's say you end up receiving less rental income than you expected, you may struggle to settle your monthly loan payments. And secondly, using more of your own money lowers how much you owe and makes it easier for the property's income to cover the loan. I hope it makes sense. One more pitfall is poor market research. And as an investor, you need to fully understand the rental demand of the type of property you're considering. You need to understand the location, the growth trends, the potential risks involved, and having little understanding of these factors I just mentioned means you're highly likely to be disappointed. You need to know your target market. Are you looking for young professionals, small families? Is the property going to be a vacation rental, an Airbnb? You need to know what kind of properties are in demand. And when you're considering an area, you need to check if there are going to be any future developments that might affect the value of the property over time. So then, market research is a critical step that can prevent you from ending up with a property that's hard to rent or resell. Get it right or get disappointed. Let's move on to the issue of due diligence, which is often overlooked, but then it's an essential step if you're going to go investing. Now, due diligence is your safeguard to verify everything you need to know about the property and the seller before you make any commitments. So then let's get more into details about this issue. What is due diligence? It's basically the process of thoroughly researching, investigating, and verifying all the important details about the property before you finalize the purchase. Now, the aim is for you to know exactly what you're buying, and it protects you from unexpected problems or financial losses. Let's look at what you need to check in the due diligence process. Number one, you need to check the legal status of the property and also verify the ownership of the property. Now, this just means that you're checking for any legal issues like liens, disputes, or outstanding taxes. Quick one. A property lien is a legal claim on an asset that allows the holder to obtain access to the property if debts are not paid. Think of a collateral. Now, many investors skip this step and they find out too late that the property has unresolved issues. And so then a lawyer can help review the property's title to ensure that everything is in order before you invest. Secondly, you need to conduct a thorough property inspection. You can't afford to skip a property inspection if you plan to rent out your property, because you want to check for structural integrity, you need to check the plumbing, electrical systems, fixtures, and anything that could affect the property's usability and value. So then if you're dealing with a new development, you have to research the development's track record for quality, ask around, read reviews, and look for any red flags in their past projects. That's why site visits are very important. And don't try to do the property inspection all by yourself. There are professionals and they can easily spot things that you would miss out on. I know there's a little price for these services, but then it's better you pay a small price now than paying a huge price later on, which would be a drain on your potential return on investment. Finally, you need to understand the market context, and you can do this by speaking with locals where the property is located and property managers, because this can help you identify any hidden challenges like security concerns or issues with utilities. And knowing the property's context in the market can provide insights that are not readily apparent on listings, or let's say when you go on property tours. As you can see, there's a lot that goes into doing your due diligence, and we've not covered everything there is to cover. So what we'll do is this. Knowing well that due diligence is a bigger topic to cover, we will dedicate an entire episode to delve into it. So do well to subscribe so you don't miss out on the upcoming series. Even with the best due diligence, every investment has some level of risk, and managing this risk is key to protecting your investment. Now let's look at some strategies to manage the risk you have to deal with when you're investing in real estate. The first strategy is to diversify. Rather than putting all your resources into a single property or location, try considering diversifying across different types of properties or even different neighborhoods. Now, this way, if one property underperforms, you have other properties to balance your returns. Now, another thing to look out for is you need to have an emergency fund. Real estate is not without its issues, and real estate is not a very liquid asset. And if you want to access your cash very quickly, then you may have to take your time with real estate because your property may take some time to sell. You don't just list your property on the market and then it sells within a day or two. Such cases happen, but then they're often rare. So you need to have some form of funds to fall back on if you need to get some quick money from the property. So then, as I always say, real estate is not a sprint, it's more of a marathon. And if you're looking into investing into real estate to make some quick money, then you may probably be in the wrong space. Real estate takes time, so you need a lot of patience for it. Another strategy is to work with experts. Now, a real estate advisor, a property manager, or a local expert can provide insights into the market that you might not catch up on your own. And yes, consulting professionals might add to some initial costs, but then it can save you a lot of money in the long run by helping you avoid costly mistakes. Lastly, don't overlook insurance. It's important that you protect your investment with the right insurance coverage. Now, depending on the property, you may need different types of insurance, such as liability, hazard, or rental income insurance. So just make sure to understand what each type covers and adjust your preferences so you can have your peace of mind. All in all, investing in real estate is full of opportunities, but then there are also potential pitfalls. By knowing common mistakes and conducting thorough due diligence and managing your risk effectively, you will be setting yourself up for a successful journey. Remember, real estate investment doesn't have to be a gamble. It can be a stable, profitable venture if approached carefully. Thanks for joining me on today's episode. If you found it helpful, do well to subscribe to the channel and share it with anyone looking to invest in real estate. I'm Desmond Kafui, and this is Ghana Ground Up. Stay informed and stay grounded. Peace.